Very good afternoon to all of you. On behalf of Auditing and Assurance Standard Board of Institute of Chartered Accountants of India, I welcome you all in this 57th CP program, that is the virtual CP meeting organized by AASB of ICI. Today we are organizing VCM on very important topic, that is the audit considerations while auditing trade receivables, trade payables, inventory and deferred tax. As we all know, we have started this series and we are going to cover all the line items in the balance sheet, covering all the assets and liabilities. So recently we have already covered PPE, intangible assets, loans and advances and borrowing. So today we are going to cover two important topics of our balance sheet, that is the trade receivable payable, inventory and deferred tax. And in order to tackle these two topics, we are having with us two eminent speakers, CA Pankaj Tiwari ji and CA Sarika ji. So I welcome on behalf of AASB of ICI. We are having with us our Honorable Vice Chairman, CA Vice Vishal Doshi ji. I welcome you, sir. And we are also having CA Prasanna Kumar DG, Vice Chairman of Professional Development Committee and Convener of Union Directorate. So on behalf of AASB of ICI, I also welcome Prasanna Kumar D, sir, for your keynote address, sir. So in order to start formally the VCM, I request Honorable Vice Chairman, sir, CA Vishal Doshi ji, to please start the proceedings, sir. Over to Honorable Vice Chairman, sir, CA Vishal Doshi ji, please.
Yeah, a very good afternoon, friends. Thank you, Anil Lalji, for this opportunity. Friends, I'm extremely delighted to share with you that this is the 57th meeting of the Auditing and Assurance Standard Board. And as you are aware that over a period of the last 2 to 3 months, we have tried to cover all the auditing standards in detail through various virtual meetings, as well as in few of the branches, we even had the physical meetings. Subsequent to that, we have taken up the asset liability wise detail about the audit considerations. And today I am fortunate to have with me my council colleague and a senior respected member, Prasanna Kumarji, who would give the keynote address. We also have expert speakers, CA Sarika Gosenji and CA Pankaj Tiwari, who are going to lead us through the important topic of audit considerations, trade receivables and payables, inventory and deferred tax. Among these four topics, I would say the first two of the trade receivables and payables have become extremely important, especially with the Schedule 3 disclosures, the additional disclosures which are required with respect to the disputed, undisputed, and the aging analysis that is there. And I'm very happy that we have the experts today who would take us through that. Inventory has always been an area, and I'm happy to share that even during the COVID-19, the lockdown, the AASB was amongst the first to come out with the guidance on the physical verification of inventories and how that should be done, especially when the auditors are not, the physical verification would be difficult. And in that case, the audit of inventories, how it can be done. There was a guidance issued on that. And the fourth topic is on deferred tax. Let me tell you, friends, honestly, what I feel is deferred tax is an area that is neglected, and especially when it comes to the non-corporates or the small private companies. I can see both the speakers nodding their head, which shows that yes, that is an area, and I'm happy that at the AASB we have the experts today who would tell us that deferred tax is not as the general stakeholders feel that it is only for the large companies, listed companies. Deferred tax as an accounting standard is applicable to all entities, and more so especially if I talk of the non-corporates, because there we have the difference in the taxation. Depreciation, I would say, especially when we provide as per the Income Tax Act, there can be a different methodology that is there as per the accounting standards, and also for the small companies. So I'm happy that these four topics that are there today, the trade receivables, the trade payables, the inventories and deferred tax, these are extremely significant when we talk of the asset side of the financial statements, and especially the non-current assets and liabilities, especially the non-current portion of the assets liabilities. The current portion of the assets liabilities when it comes to receivables, payables, and inventories. So friends, once again, I welcome you to this webinar of the AASB, and look forward to your active participation and also your suggestions on the areas that you want us to cover by way of these webinars. We would be more than happy to get inputs from you all. So with this, I once again welcome all of you. Thank the speakers. And I would now request Prasanna Kumarji to kindly deliver his keynote address. Over to you, sir. Sir, it seems you are on mute, sir.
Exactly. Right. I realize. Okay. Respected CA Vishal Doshi, the Vice Chairman of the WASB, and the CA Dr. Sanjeev Singhal, the Chairman of WASB, and the speakers of today's two sessions, one is CA Sarika and CA Pankaj, and their participants. So good afternoon to all of you. It's a great privilege and proud moment for me to participate in this today's webinar and to deliver a keynote address for a couple of minutes. Friends, as you know, WASB is one of the most important committees of the boards of the ICI. WASB in the current year, that is 22-23, is doing a very great job under the dynamic leadership of Chairman and Vice Chairman. The lucky factor today, this year for WASB is both the Chairman and Vice Chairman, they've got great experience, domain knowledge, a domain application in as far as the auditing assurance standards are concerned. So that's a great advantage. It's not that every committee chairman or vice chairman, they've got a knowledge in the subject. They may be good administrators, but may not be knowledge subject experts. But it's good that both the chairman and vice chairman, they are not only experts in the subject, but also great administrators. Thereby, this board has become hyperactive in the current year 2023. So they have been conducting many webinars and even WASB meetings. If you see the number of meetings that have been held by WASB, I think maybe this year is going to be the highest number of meetings ever held in the history of ICA. That's the way they are functioning a lot. And be it CARO, which is very important during the current year, because the first time it's getting introduced, implemented. So CARO, they came with a very good guidance note. Both the chairman and vice chairman put their entire experts and got it getting them released of the approved from the council recently. And like that, they're dealing with all the contemporary subjects are relevant to auditing and assurance standards, so are being dealt very regularly by them. They are also holding number of outreach programs, which is a welcome measure because auditing assurance standards so important. The documentation and the procedures to be adopted is so important. So whenever in future, be it regulators or a disciplinary mechanism or investigation agencies, everywhere, if you have to stand by what you have done it, and this, unless we apply all these standards and take shelter under them, and a proper documentation is done for that, we will not be able to, sustain or keep it as evidence to see that we are not caught anywhere in this type of processes. And it's nice to note, as the vice chairman has said, that item wise they have picked up. So audit considerations, item wise in both the balance sheet and profit and loss. But of course, more importantly, the balance sheet. In that process, I understand they already completed the PPE and other topics have been covered. Now it has come to the turn of the current liabilities and the current assets. More importantly, the three items which are important in current liabilities assets are the inventory and trade receivables and trade payables. They are very, very important topics. These are more relevant, not only with reference to auditing and assurance, also they are relevant because there's a reporting also need to be done in the CARO regarding the current assets and current liabilities with respect to bank financing also. So under these circumstances, I'm sure their deliberations today are going to be very useful to all of us, including me. I think my partners from Visakhapatnam, they're also attending this program. So they will be watching me from my office. So they're also very interested. Like the vice chairman has already told us, deferred tax is a very tricky subject. Some feel is applicable, is mandatory for the non-corporate entities also. But his general feeling is it's not applicable to me. Forget about non-corporates. In corporates also, small corporates, they feel is not applicable to us. Like the vice chairman said, as long as you've got fixed assets, depreciation will follow with that. As long as depreciation is there, in the present circumstances, present law in our country, there cannot be even a single company which doesn't have current deferred tax assets or liability in most of the cases. That's the situation. But still, as per the observation, instead, I'm not telling all, there are some. Still, the deferred tax asset or liability doesn't appear in the balance sheet at all. So under these circumstances, today's deliberations on these two topics of paramount importance. I'm sure the two youngsters, Sarika and Pankaj, so they're very enthusiastic. See, look at their face also. Like Vice Chairman said, we're glowing faces now. So they are going to share their knowledge with us, because these two guys, Pankaj and Sarika, I understand they got hands-on experience with the entire thing. So that is very important. Looking at the theory, learning the theory with a PowerPoint presentation. If somebody wants to present, I can also present a topic on blockchain technology without understanding what is blockchain. That's not important. Today's speakers got great experience, hands-on experience are there. I'm sure all of us will certainly benefit out of that. With this, already from February 12th onwards, 57 programs have been covered already. Less than 5 months time. They conducted, I think, last year. Same Anil Lal was the secretary, and I was the vice chairman. Sanjeev Singhal was the chairman of Committee for Membership Practice. By 11th February, we conducted 100 programs. But I think that the way in which the trend is going on, I think we'll have 200 programs. And by the end of 11th February next year, 2023, I don't think any practitioners are left without knowledge of auditing assurance standards. It's a great initiative. Wish you all the best. I compliment the AASB for such a great initiatives. I thank all the participants for participating, very great number. So out of all the programs every committee is conducting, AASB will have the least number of attendance normally. Any branch will conduct. But I don't know what is the magic of this, the chairman or vice chairman. Now AASB programs, the highly attended. Compared to any other program, the highest attendance you are getting here, that is the interest they have created. That's a welcome measure. With this, I wish you all the best. Thanks a lot for giving me an opportunity to address for a moment. Thank you so much. Very nice. Thank you.
Thank you so much, sir. Thank you so much for your words of wisdom and sparing your valuable time in spite of your busy schedule. On behalf of AASB of ICI, I extend my heartiest thanks, sir. Thank you so much, sir. Thank you so much, sir.
Thank you.
Sir,
Thank you,
Vice Chairman, sir, if you permit, can we start our first technical session?
Yes, please, Arjunji. Thank you, Prakash.
Thank you,
for
sir.
your
Thank
kind
you.
words
Moving on.
and motivation.
Thank you, Vishal. Thank you.
Thank you, sir. Thank you. Moving on our first technical session, that is the audit consideration while auditing trade receivable and inventory. We are having with us Madam Sarika Gosainji. It is my proud privilege to share with all of you the brief profile of Sarika, Madam. Sarika ji is a chartered accountant and company secretary, and also had a diploma in IFRS from the ACCA UK and in BRSR from ICAI. She has got around 19 years of post-qualification experience, and currently she is heading the technical function of Mazars in India and also leading firms ESG and sustainability practice. Her current responsibilities include technical research, advisory, and L&D initiative of the firm. And her past experience includes servicing large clients in the areas of audit, accounting, and advisory. On professional front, she has co-authored 2 books and also speak on a couple of forums. She has also keeps talking on a couple of functional educational projects as well as VCM webinars conducted by Institute of Chartered Accountants of India. So without wasting much more time, I request Sarika Madam to please enlighten all of us on various intricacies while auditing the trade receivable and inventory. Over to Sarika Madam, please.
Thank you, sir. Thank you so much. So on the onset of my presentation, I would like to extend my heartiest thanks to AASB and everybody who is present here. And, just a moment. And without wasting anybody's time, I would like to start because we have been given responsibility to cover 2 very important topics. So let's get started. So I have been given as 2 items. One is trade receivable, which I will be covering first, and then inventories. I'm sure my screen is visible, sir?
Yes, ma'am. Yes, ma'am.
Okay, sir. So as an introduction of trade receivable and all, CARO 2020 as well as Schedule 3 has brought in a lot of responsibilities for the corporates as well as the auditors, and a lot of new reporting requirements and disclosure requirements have also been added. So whatever is being added for the companies is a responsibility of the auditors as well to verify it and to report it accordingly. So trade receivables and inventories are 2 of them. So firstly, we will cover trade receivable. So if in terms of guidance, if we look at for trade receivable, we have guidance note on division 1, that is for non-Ind AS compliant companies. Division 2, which is for Ind AS compliant companies. Division 3 is for Ind AS compliant NBFCs. And last but not the least, for trade receivables, we have a guidance note on audit of debtors, loans and advances, which will largely cover the guidance which is coming for that. If we talk about, auditors' responsibilities in general, which was always there, which has been covered by this guidance note. So what factors which we need to evaluate is first the internal control evaluation of the company before we even start anything. So this is done to understand the nature, timing, and extent of our audit procedures. How much in detail audit procedures need to be conducted on those numbers, on the existence of those items, is something which will be initially driven from the evaluation of internal controls of a company. Then we need to do the verification of records to understand the validity, accuracy, and recoverability of the debtor balances. Then direct confirmation procedure is better to ascertain whether the balances which are appearing in the balance sheet of a company are genuine, accurately stated, and are undisputed. If there is a dispute, that will come through the direct confirmation procedure. Analytical review procedures are very much required to be performed even before we start as a detailed verification of trade receivable. This analytical review procedures which will largely cover the comparison of the closing balances of the current year with the corresponding figures, the relationship of the debtors and the current sales vis-a-vis the corresponding previous year. Similarly, the comparison of the current aging schedule is a must with that of the previous financial year. So evaluation of the internal control and verification of these aspects will give me a fair idea about the existence, accuracy, whether these are undisputed at the first glance. Then only after I verify these debtors or trade receivables, so to say, I will be able to understand to what extent I need to do my extensive procedures. Disclosure is something which is very much required, first of all, from the company side, and then for us to evaluate whether it is complete or not. And is there a need to modify my report accordingly if the disclosures are not complete. Management representation at times is very, very important for those aspects which are beyond a verification, or where the management perception plays a very important role, largely for and with respect to the recoverability of the debtors, their classification, how they want to classify, what is their belief system in classification of debtors as at the balance sheet date. So management representation at times is equally important as that of our own audit procedures. So the factors which you can see on your screen are not per se affected by any additional requirement of Schedule 3 or CARO 2020. These have been there since ages, ever since we started studying our chartered accountancy course, or we thought of auditing any account balances, etc. So these are must to be considered and to be performed. Documentation, needless to say, is very, very important. Whatever procedures we are doing here, what I've mentioned, or what we are going to discuss in slides to come. If we talk about in terms of CARO and Schedule 3, CARO hasn't brought any new requirement for trade receivable, but Schedule 3 has brought very important disclosure requirement for the companies to make and as an auditor to verify. So what are the reporting requirements in terms of different types of companies? What we just understood, Division 1, Division 2, Division 3. There are slight differences. Therefore, in terms of the balance sheet or P&L, if required, or notes to the accounts, whatever different requirements are applicable for Division 1, 2, 3, we will separately discuss, but very quickly. So this is how my balance sheet would look like as far as my trade receivable are concerned. So for Division 1 company, this will be covered under the head current assets. My current year figures and my previous period figures will of course be given. With respect to Division 2, this will appear under current assets, of course, but under a subcategory of financial assets. For Division 3, which is again Ind AS compliant NBFCs, similar requirement as that of Division 2 will be applicable. That therefore, trade receivable will be placed under financial assets under the head of receivables. Again, current year figure and the preceding previous year's figures will be given. If I talk about notes to the accounts, trade receivables are to be subclassified as secured considered good, unsecured considered good, doubtful, but this category is only applicable for division 1, which have significant increase in credit risk. That will be applicable for division 2 and division 3 for a very simple reason. Division 1 is with respect to non-Ind AS compliant companies, and this credit risk assessment is not so far done for division 1 companies. Therefore, division 2 companies, which are normal Ind AS compliant companies, and NBFCs which are following Ind AS, will have this category in their notes to the accounts. Credit impaired, again, for the similar reason, will be given only for division 2 and division 3 and not for division 1. So this is a subcategorization which is required by revised requirements as per schedule 3. Allowances for bad and doubtful debts or impaired losses will be disclosed separately with respect to credit losses on these items separately under the relevant head separately. Dues which are due by the directors or other officers or any company or NBFC, either severally or jointly with any other person, or any dues which are due from any firm or partnership or private companies respectively, in which directors of the company is a partner or a director, has to be disclosed separately. That's a new requirement as per schedule 3. Impairment on trade receivable, that is again applicable only for division 2 and division 3, has to be given separately, as I mentioned above as well. So what is my impairment, which is loss allowance, that has to be calculated as per the ECL method. I'm sure whoever is dealing with the financial instruments would be knowing. Whoever are dealing with division 2, division 3 companies will definitely know about it. We won't be able to discuss that in detail, but that ECL model, the calculation of losses is to be provided for all financial assets, including trade receivable. Henceforth, we have to give that part of impairment separately under the required head as per schedule 3. So there is an additional requirement which has been added from this year as per revised schedule 3, where we have to give different buckets as far as the amount of debtors or rather receivable is due. And these buckets are less than 6 months, 6 months to 1 year, 1 year to 2 years, 2 years to 3 years, and more than 3 years, and a total of it has to be given. So this is, initially there was a lot of hues and cries by the companies, it is very difficult to maintain and how to give that detail. But the intent of the regulator, including MCA, is very, very clear. They want to see the clear picture that out of your accumulated balance of trade receivable, how much is very new, how much is old, and how much is very, very old. So this bucketization of the trade receivable will give a very clear picture to the stakeholders and the regulators at large, where the amount is struck in trade receivable. Is it disputed? Is it undisputed? Is it considered good? It is considered doubtful. All these categories are required to be given here. And this is a welcome step by the regulators and well appreciated by everybody. By looking at the financial statements of a particular company, we can understand what is the aging of the debtors which are pending with the company. Is it a viable company to invest in, or any other decision any stakeholder want to make? Similar requirement will also apply for those debtors or those receivable where due date is not mentioned. In those cases, the disclosure shall relate from the date when the transaction had happened. So if the due date is not mentioned, the aging will be calculated from the date of the transaction. One more clarification, very important clarification, which is provided by the guidance note of ICI. They have clarified that the unbilled dues shall also be given separately. What are unbilled dues? When we have a right to receive, technical right to receive any amount, is just that we haven't raised the invoice, that becomes my unbilled dues. So that has to be disclosed separately. To give the entire reconciliation of the amounts which are appearing in my balance sheet and what I'm giving here in the notes to the accounts, the guidance note suggests that you have to add two columns, namely unbilled dues and the dues which are not due so far. So if I give this bucketization together with a new column which is unbilled and which is not due, this will total up and will match to my financial statements and will give a correct picture. Because if I remove unbilled and not due from here, my total will not match. So that's a clarification which was given by the guidance note. And now you can see a couple of companies who have already published their financial statements, how they have structured and given this entire aging schedule of trade receivables. So this was for Division 1 company. Now moving to Division 2 company, similar bucketization is to be given, which is for less than 6 months, 6 to 1 year, 1 to 2, 2 to 3, more than 3. However, the categorization, what you can see, is slightly different, where disputed, undisputed is further bifurcated into one more category, which is credit impaired. Those who are dealing with the companies, Ind AS compliant companies, would know what is credit impaired. So that is a condition where there is a significant risk on recoverability of the items, and the companies have doubts basis certain condition that the amount will not be received to a larger extent. So there are some triggering events or certain examples which are given as per the financial instrument standards. So this categorization has to be given in the similar buckets with one more category, which is credit impaired. Similarly, if the due date is not mentioned, we will start the due date calculation from the date of the transaction. Similar unbilled dues are also to be disclosed separately, and this total should match with my figures which are appearing in the balance sheet. I hope I'm not going that fast, but since these two topics needs to cover a lot, I'm trying to do justice to the time given to me as well as the content. Wherever you feel I'm going fast, please raise your query and the ICI team will take care of those questions. I will try to address all of your questions to the extent I can, depending upon the time availability. It might also happen that some question is very peculiar in nature and I need to do some research. That's my promise. If that is the need, I will do my homework, I will do my research and mail it back to you, whoever the question seeker is. Now moving ahead for clarifications which are given by Schedule 3 guidance note, which has been issued by ICI, and that was something where it was not cleared by reading Schedule 3 revised as such. So it has been clarified by ICI guidance note that the amounts which are due under contractual obligations will not be included in the trade receivable. So just to give you an example, insurance claim, or if we are selling any items of property, plant and equipment, or very important aspect, if interest is accrued on trade receivable because of some delay which has happened on the part of the debtors, that will also not form part of the trade receivable. That has to be shown separately. Similarly, as I quickly mentioned, what is the definition of unbilled receivable? So I just read the verbatim of it. So if unconditional right to consideration is established before it is invoiced, it will become an unbilled receivable that will be shown separately and under that schedule, as I just mentioned. There is a new requirement in terms of the analytical ratio of regarding the trade receivable, which is again coming from Schedule 3. So I've quickly kept everything. So wherever the trade receivable are getting covered, be it CARO if applicable, here it is not, or Schedule 3 or the guidance note what has been issued by ICI. So in this case, there were two guidance notes. One was on the Schedule 3 and one was on the audit of trade receivable. So I've tried to cover very, very important information which will make this PPT a comprehensive PPT. So apart from other analytical ratio, trade receivable turnover ratio is also very important ratio, which is required to be given by the companies. So trade receivable ratio will be calculated basis the net credit sales divided by average account receivable. And it has been clarified that by that guidance note. Again, if my opening closing are not available, or I'm not able to get the net credit sale figure, I can pick up the closing balances from my balance sheet or the P&L. So that is a clarity which has been given by the guidance note from ICI. It has been specifically mentioned that every company is required to give these ratios from year-on-year basis. And if the result of this ratio is varying more than 25% as compared to its own results in the previous financial year, and that result is more than 25%, then the explanation has to be provided by the company, whether what has changed. Is it a formula? Is it increase or decrease in the activity, or any other reason whatsoever why this ratio is changing by more than 25%. This will serve a very good purpose with respect to comparability of the company's operation itself, as well as comparing two companies in the same industry or of the same size, to compare this ratio together with other ratio. Now, we understood what are the basic requirements in terms of Schedule 3. We understood what are the basic audit procedures as a whole, which we have been following. We also understood, the ratios, etc., what have been added. But because of Schedule 3 revised, whatever disclosures are added for the companies, what are my additional responsibilities as an auditor that we need to understand. So as I mentioned, Schedule 3 is though required for the companies to be followed, but since we as an auditor have to verify everything and anything what are being given by the companies as a whole, we need to also comment upon, is it appropriate, is it adequate, is it sufficient as per the required rules, regulation, or our auditing standard per se, are those following in those parameters. So with respect to Schedule 3 revised, there are certain additional responsibilities which are given to the auditors also, and we will quickly understand on one of the slides. So first of all, what approach companies should follow? Obviously, they have to have a robust documentation system and internal control systems. And why I'm saying so, this is all supported by my previous slide, where the companies need to provide different buckets of 6 months, less than 6 months, more than 6 months, up to 1 year. And you cannot, as a company, calculate these numbers or those aging manually every time. This has to be embedded in the system. This has to come from your SOPs. This has to be supported by your systems and controls. So after the introduction of Schedule 3, there was a need, and there is a need to have a robust documentation, SOPs, internal controls around calculating that aging and the additional disclosure requirements which are mandated through Schedule 3 revised. For a very simple reason, every time manual thing cannot be relied upon by any external body, including the regulators or the stakeholders or the auditors. So there was a need, and there is a need to upgrade the systems from the company side. Similarly, tracking of disputed and undisputed trade receivable is something, since that it has to be categorically mentioned. And ICI guidance note has also clarified what is the meaning of disputed. It is very subjective, and we have to understand every aspect, every case from other case differently. So in general term, the clarification has been provided by the guidance note. We may refer to that. Companies also need to understand what are the implications in case of breach of contractual terms. For very simple reason, as we just understood, that 25%, if there is a deviation, we have to give the explanation. And if that ratio is to be given in any of the covenants for or with respect to any of your borrowings or funding what the company might have taken, they have to understand what are the implications of breaching that ratio or any of the contractual terms with the debtors or related to the debtors. In terms of approach for auditors, obviously, whatever, as I mentioned, is being mentioned by the companies as their disclosure, that needs to be verified by the auditors and have to be reported accordingly. If it is not in compliance with Schedule 3 requirements or any of the generic requirement as per law or any of the prudential norms, then the auditors are required or are under the obligation to report accordingly. And if these are not in compliance, then we are free to modify or report accordingly as per the situation. So there are a lot of responsibilities on auditors as well, with the increased disclosure requirements as per revised Schedule 3. And the scope of inquiry obviously has increased a lot with these increased responsibilities on the part of the company. I'm sure this is just a one-way traffic. I'm speaking and you're listening, but ICI team is having eyes on what you're writing in the check. So just to make it a little interactive from my side, there are a few questions which I just spoke about. So you may send your answers on each and every question to on the chat box, and our team will receive it and we'll see it later. So my first question on your screen is, Division 2 and Division 3 companies are required to recognize a loss allowance for expected credit loss on financial assets, including trade receivable. Is it true or false? You have 15 seconds to respond to ICI people and they will see it. I just repeat, Division 2 and Division 3 companies are required to recognize a loss allowance for ECL on financial assets, including trade receivable. Is it a right statement to make? Yes or no? 5 more seconds. Okay, so the answer is true. As I just mentioned, both the companies are required to recognize the loss allowance as per ECL model, as per the financial instrument standard, on all the financial assets, including trade receivables, and therefore this answer is correct. The second question on your screen is, for trade receivables where no due dates of payment is specified, in that case, disclosure shall be from the date of the transaction. Am I saying it right? Yes or no? Is it false or true? I've changed the sequence. So in case the due dates of payment are not mentioned in any of the contract with the receivable party, in that case, can I make the disclosure as a company starting from the date of the transaction? Is it a right statement or a wrong statement? You have 15 seconds. Yes, it is true. I very well told that time that it is clarified by the guidance note. If the due date is not available, we have to calculate all aging for the purpose of that disclosure from the date of the transaction. Next, amount due under contractual obligation to be included within trade receivable. Is it true or false? I categorically mentioned that there's a specific clarification from the guidance note, which was very much required. If there are some receivable which are booked as a contractual obligation, is it required to be booked as trade receivable? I cited certain examples also, like insurance claims or sale of PPE, or rather interest recoverable on trade receivable because of some delay or default. You have 10 more seconds. So my question is it yes or no? Is it to be included or no? And the answer is false, because I categorically mentioned these are not in the nature of trade receivable for the purpose of disclosure under Schedule 3 revised. Therefore, that will be shown separately from trade receivables. Next question is, in trade receivables, aging schedule to tie up the amount presented in total column. So I told you that there is a specific requirement, but there's a clarification. You have to add 2 line items to match the total with my balance sheet number. So those 2 items are, I think there are two options, if I'm not mistaken. Is it unbilled and not due, unbilled, and the second item is due but not paid? What did I say? Please try to recall. 10 more seconds. Yes, it is A, unbilled and not due. So apart from what we discussed, disputed, not disputed, you have to give two columns separately for unbilled and not due to match the entire total of my trade receivable with my balance sheet items. Two last questions on this topic. Which of the following is a new requirement as far as trade receivables are concerned? One is disclosure of trade receivables turnover ratio, disclosure of bad debt and doubtful debts. I did mention categorically that this is a new requirement. This will help the companies to compare their functioning with themselves as compared to the previous year and the companies as their peers. 5 seconds. Yes, this is trade receivable turnover ratio, and I also mentioned that if it varies by 25% as compared to your previous year, you have to give an explanation also to that aspect. Next, which of the following criteria is not there in aging schedule of trade receivable? I just repeat, which of the following criteria is not there in the aging schedule of trade receivable? It is less than 3 months or less than 6 months, which is not there in my buckets, which I discussed. 10 seconds. Yes, we did not read 3 months. So we started with 6 months and less, but 3 months was not mentioned. So obviously 3 months will come under the category of less than 6 months, but less than 3 months, that categorization is not there under Schedule 3 revised. With this, I'm done half of my presentation. So quickly, what did we understand? We understood the basic requirements of audit, which are always prevalent through that guidance note on audit of loans and advances, including receivables. We understood the new requirements which are brought to the companies through Schedule 3 revised. So we have 3 different layers: Division 1, Division 2, Division 3. Division 1 applicable for non-Ind AS compliant companies, Division 2 for Ind AS compliant companies, and Division 3 for Ind AS compliant NBFC companies. So there were slight differences in terms of disclosures, in terms of buckets which are required for aging, but largely the objective of the regulators is to see the backlog, where the amount is struck. Is it too old or it is just a new one, so that the liquidity position of the company can be assessed by anybody looking at the financial statements. Since the requirements of companies are enlarged, equally the responsibilities of the auditors are equally increased to verify those information. So in terms of guidance, we have guidance note on Schedule 3. All the 3 divisions we have separate guidance, and since CARO is not applicable for this item specifically, CARO also throws some guidance for item like inventories we will be discussing. So we have not only to understand the auditing standards, but we have to understand the basic guidance which are applicable to companies. So if we are actually aware about the guidance which are applicable, our half of the battle is done. So it is very, very important to understand what topic gets covered by what all guidances around us. And we should know that which topic is covered by what. If we at least know this, and in case of need, we are ready to read and understand, we are all sorted. So the problem is, unless we don't know what all guidance covers my topic under audit, I won't be able to do the effective audit. So that is very, very important and a must thing for we as professional to understand and know and update ourselves. So we should not think that we have become a chartered accountant now. There's no need to study. Even a doctor keeps studying every day. New technologies, new medicines keep coming. Had he not studied those, imagine what would he do to the patients which are coming in the current era. Similarly, that holds good for us. We should keep ourselves updated. We should keep understand, evaluate those guidance. Okay, coming to the second part of my session, that will cover inventory. And needless to say, it is very, very important part of the balance sheet, and a very important caption of any company's financial statements. And again, as I just mentioned, first of all, we should have very clear idea in our mind that what all guidance will cover this caption. So the guidance note again for division 1, 2, and 3, and guidance note on inventories is again important, which at times people miss. We should also refer to that, because these are very important, though basic, but these are the backbone of my audit procedure. So we should not forget to refer to these if we are stuck somewhere. There is a guidance note on Caro, and I'm sure few people might have missed. There are MCQs on guidance note also. So guidance note 2020 on Caro and MCQ will give me the entire picture for all the reporting requirements for auditors on the new Caro requirements. So please do not miss. And as Sir initially said, AASB had issued certain guidance in the COVID period for additional procedures to be performed for and in case of restrictions like COVID, where we could not visit some locations and there were restrictions, there were some security concerns, etc., etc. So those guidance are additionally available. These are still available on the ICAI website. Still, if we have similar kind of situation where because of n number of reasons the physical verification is not being possible, we can at least draw inference from those guidance and apply those in our current audits. So please do not miss on this aspect. We should at least know what all guidances are available. If we are through with these, then rest is very much in our hands, because being a chartered accountant, we are so equipped with reading habits and doing research. So if these are in front of us, we can do and we can achieve anything. So what are the additional reporting requirements as per Schedule 3? We will first understand that, then we will understand additional requirements because of Schedule 3 and normal in parlance, what physical verification process, when we will follow. So that is there in my upcoming section. So just like we understood for receivable, what time I have? Yeah, I'll try to finish it off in my given time. So with respect to division 1 and 2, these are shown under current assets. With respect to division 3, these are shown under non-financial assets, again for current financial year and the previous financial year as comparative. In notes to the account, Schedule 3 revised tells me to bifurcate into raw material, work in progress, finished goods, stock in trade, stores and spares, loose tools, and others. And if you have to specify the nature. Goods in transit shall be disclosed separately under the relevant subcategory. So that means if it belongs to work in progress, it will be shown there. If it belongs to raw material, it will be shown there. Mode of valuation is very, very important to be stated, how the company has valued a particular piece of inventory. If I talk about a statement of profit and loss account, because my inventory will also give rise to some items which will be there as an expense. So cost of material consumed, purchases of stock in trade, changes in inventories, be it finished goods, WIP or stock in trade, will form part of my expenses, and hence it will be given in statement of profit and loss account for all the 3 divisions, 1, 2, and 3. Just like trade receivable, revised Schedule 3 also asked me to give as a company analytical ratio, which includes inventory turnover ratio also, which shall be calculated as per cost of goods sold or sales divided by average inventory. If opening closing figures are not available, the guidance note allows me to pick my closing balances. And if again one particular year exceeds by 25% in terms of the ratio, there is a need to provide explanation by the company side. Auditor's responsibilities in general. So my responsibility in general is with physical verification of the inventory, and physical verification of inventory is largely done to verify the existence of the inventory. So what is the objective of physical verification largely? Again, so this is not a new thing, but we should keep reiterating certain aspects. If there is a missing block, we can again fill it, and we become again very good auditor. So these are not something very new unless I speak about Schedule 3 guidance and additional responsibilities. So this is something we have been studying ever since we were article trainees, but since we are talking about the completeness, so I'm giving the complete guidance, what I have read through, I have considered in my audits, I advise my clients to do. So the objective of physical verification is always to support the value as well as the existence of the stock, which is appearing in the balance sheet on a particular date, accuracy of the stock records, of course, then to understand and see and evaluate if there is a possibility of fraud, theft, or losses in any manner. Is there a weakness in the internal control system of the company? So as I mentioned, if the internal control system is weak, I need to extend my substantive procedure. I have to increase my ambit of verification. So understanding the system is that important. So as everybody knows, there are two types of stock verification procedures. One is periodic stock verification. The other one is perpetual stock verification. Periodic verification of stock is done once a year or twice in a year, max generally once a year. Physical counting is done on a particular date, and it is largely suitable for smaller organization, while perpetual stock verification is done for larger organization where it is spread throughout the year, and each item has to be physically verified at least once a year. And during the physical verification, stores or work or movement of the stock is not largely closed, unlike the periodic one. When you are going for physical verification, the movement is largely stopped, or we keep that data separately and then we reconcile. Whatever surpluses or shortages are there, these are adjusted with the proper investigation and management approval. How we proceed, that's a simple chart. Again, it seems tricky, but very simple. That's a technical chart. We will do planning, then we'll do collecting procedures. That means what management is doing. If those procedures are written, if we come down, then we will do whether those procedures are adequate. If those are adequate, reliable, I will see if I have to attend. If yes, if I attend, I will tie up the figures, what is being given on papers and what is I have verified, seen with my eyes, and then I will conclude for any shortage or surplus. However, if there are no written procedures, then we have to make the management write those procedures. We have to get the description of those procedures. If that is done, I will come to my regular chain. If the procedures are not reliable, then I have to communicate the same to the management, and then after that I will obviously attend the physical verification, but I have to do additional procedures. Okay, so this is the entire procedure we have been doing, is just a simple bird eye view. So in these categories, we'll quickly take you through what needs to be done. So for planning, I cannot give one single pill to every patient for different remedies. Similarly, the physical verification of different entities have to be planned in a different manner, understanding their processes, locations, and how they are reviewing, etc., etc. So knowledge about the entity and its environment is a must to plan my physical verification. Similarly, knowledge of physical counting technique, which is being done by the company or required for that industry, is very, very important. One item may be weighed in terms of kg, one may be a liquid which requires volume assessment, or some of them require density assessment, etc., etc. So that is also very much required. I should have that knowledge. Attending physical verification is not mandatory. Yes, that is written in my technical standard. However, we end up doing so because inventory is largely material to my financial statement. So auditor has to understand the risk, what I'm carrying, and inventory is always a risky item not to verify, and it is always and generally material. So we end we end up doing that physical verification in each and every case. Attending physical verification count on all location is again technically not material, but that judgment has to be taken by the auditor depending upon the materiality of the location, the sensitivity of that area or the items held by that location, and the overall objective of my physical verification is met or not. That assessment has to be done. So this everything comes under the part of the planning. If planning goes right, everything thereafter will go right. If I'm wrong at planning stage, everything will go haywire going forward. Collecting procedure means collecting the procedure what management is doing. So what management is doing, we have to understand it is reliable. Is it something which is correct, which is incorrect? And then what samples of inventory need to be picked up based on those procedures. There may be certain items of inventory which may not be observable. For example, certain items may be good in transits. At the time when we are doing the physical verification, inventories might be held by third parties or belong to third parties, and we have to also understand what kind of confirmation request, whether open or closed, positive, negative confirmation we have sent. So this is all covered under the collecting procedures. So I am done with my planning, what to do. This is how to start. So I have to understand the management procedures. What are the difficulties? What are observable? What are not observable? If these are not observable, what alternative procedures I have to perform to get the comfort on the existence and valuation of that inventory part. That is very, very important. Assessment of procedures. So choice of the date. When no permanent inventory exists, I can do it in physical verification on the financial statement date. If permanent inventory exists, I can do it before the financial statements also, but I have to see when I can do it, when activity is quite slow and storage level is low and time difference is limited. That means when I'm doing and when it is required to be done, that time delta is not that much. So permanent inventory verification or non-permanent inventory verification differs in its procedures and evaluation. So please take a call what kind of or what type of physical verification you want to do, when to do. If it is not done on the date of the financial statement, what rollback or roll forward procedures you have to perform. Also, we have to understand if it's a continuing client, whatever procedures were performed by us or by the management or by my own peers in past, whether those were reliable, that will definitely give me a good experience to start in the current year. Attendance of physical verification, what approach? As I said, if it's at the year end, no movement of the physical inventory count should be there. Control over existence and completeness of the count. I should be able to assess how many, out of how many items I have covered, how much is it giving me a comprehensive picture? Should I do the complete verification? That all I need to check. So these are some of the items which are covered here. Now tie up. I am done with my physical verification. I have the listing available. I have to make a reconciliation and I have to objectively conclude, document all the key figures, summary of the work performed, and whatever points I have gathered and what is my conclusion based on that verification. Everything will be covered in my summary memorandum. And work papers have to be classified in the inventory section of my current audit file. So this is not part of my permanent audit file. So this has to be sectionized in the current inventory section of my current audit file. And everything has to be documented, be it inventory procedures, count sheet, or summary memorandum as we just discussed. And what are the list of all items which are not regular, like obsolete or slow moving, etc. Obviously, testing of cutoff. What is the date of cutoff? What is being decided with the management? If there are discrepancies, we have to report. And the reasons of the discrepancies, as everybody knows, maybe the pilferage or something came in, we could not report it, we reported incorrectly, we reported in a different ledger, or posting is done on a wrong date or wrong card, or error that may be manual, adding, subtracting, and we have to report or make these two lists separately, shortage and excess, and have to report it to the management and adjust that depending upon the situation. So this was the normal procedure for inventory verification, as I mentioned. So just like we did for this thing, receivable, CARO section was not applicable. So see what all additional requirement for CARO has been added. So two important aspects. So I would like to bring everybody here and bring all your energies here, because that's very important aspect. If you did not understand it or did not understand it the way I want you to understand. So there are two different additional requirements which have been added. So one is written in the middle column in the bold, and one is in red. So the bold says, which was not there earlier, it was only written material. So in place of material, that materiality has been defined as 10% or more. Apart from that, which I have discussed first, there is another paragraph which is written in the bold. It says, in the opinion of the auditor, the coverage and the procedure of such verification by the management is appropriate. So just like PPE, additional responsibility has been put on the shoulders of the auditor, that we have to tell to the outsiders or the stakeholders whether, in my opinion, the coverage and the procedure which was adopted by the management, is it appropriate? Yes or no? It is very, very subjective. I may call it as appropriate, you might not call it as appropriate. So whatever our decision is, that should be well documented, supported by the corroborative evidence or whatever we obtained. That is what we can do and we should do. So these are two additional requirements. One is the materiality was not defined earlier, that has been defined by 10% or more for each class of category. And second is the opinion of mine will find place in CARO 2020 report, where I have to say whether the coverage and the procedure of such verification by the management is appropriate or not. And because of these two aspects, I am required to perform more, I'm required to inquire more, I am required to document more, and that is my additional responsibility. So with regards to this, that's again, as I mentioned, is a professional judgment whether it is appropriate in terms of coverage and procedure. That is one. Secondly, the discrepancy of 10% or more. For any class of inventory, I have to make sure that if that is the case, that has been dealt with, and what is the impact of that discrepancy on my financial statement. And if that is not established and I'm not able to establish because of the nature of the items dealt with by the company, I have to sort of disclaim that aspect, that I am not able to calculate that discrepancy because that is not possible. Yeah. And if it's a perpetual inventory system, if it is happening throughout the year, that 10% will be calculated in aggregate throughout those processes. That has been clarified by the guidance note on CARO. That is an important aspect. With regards to CARO, we have just discussed. With regards to Schedule 3, or together with CARO, you can say what companies are required to do additionally. So as I said, auditors are required to perform more because there are additional requirements for companies in terms of CARO, in terms of Schedule 3, my apologies. On the contrary, if there is a need from the auditors, which is not there in Schedule 3 revised, companies are also under compulsion indirectly, for a very simple reason. If I am requiring any information from the company and company is saying, no, it is not applicable to me, what tool I have? I will have no option but to modify. Therefore, indirectly, with regards to CARO 2020 also, whatever additional requirements are added for the auditors to report upon, those are indirectly putting a lot of responsibilities on the companies also to provide or to maintain those documentation to satisfy to the auditors to give the positive report. I hope I'm clear. So Schedule 3 and CARO 2020 is putting equal responsibilities in nutshell on the companies as well as on the auditors. In brief, I can tell you. So because of these two together, the companies are required to change their approach to have more documentation, tracking of additional items, be it bucketization or be it satisfying the auditors for the appropriateness or completeness of the inventory verification process. And obviously, as I mentioned initially also, everything cannot be manual and everything cannot be produced to the auditors manually. So your system should speak. So the system should provide those reports, system should provide you those informations, those aging, those data, additional reports, whatsoever required by the auditors. Hence, companies are under compulsion to update their records or the systems also. Similarly, for auditors, as I mentioned, so these are very generic points. We have to be more vigilant. We have to increase our testing and scope or sample size. We have to have more scrutiny. We have to have more inquiry from the management, and therefore more documentation is warranted. Many places are added where professional judgment requirement is added, and needless to say, additional reporting is added for the auditors. So comprehensively, both the parties, auditee as well as auditors, are under more obligations after the introduction of Schedule 3 and CARO, besides the normal audit requirements what we have been following since ages. Similarly, as a ritual, few questions. This is not a burden, but it will give you a quick review of what we have done, and you will be able to bring more to home, that is more take home after these view checks. Again, requesting to write in the chat box, and our team will look at it and we'll see it later. So the first question on your screen, and it has 4 options. While reporting under this clause, which of the following is correct? 10% threshold for reporting must be applied on gross basis. 10% threshold for reporting must be applied on gross basis before adjusting excess. Again, so this is about 10%, but what is the change you have to figure out, and let me know which is the correct answer. You have 15 seconds to answer this. So the difference lies in the last line. Is it each class, all classes, value of each class again, and value of all classes? So there are slight difference in the language. Just look at it, 5 more seconds. And C is the right answer. 10% threshold for reporting must be applied on net basis. So gross basis is incorrect. Therefore, first 2 items are out of the scope, and it is to be applied for each class. Therefore, the D option is again incorrect. Now moving to question number 2. Only in cases where discrepancies of 10% or more arises in quality for any class of inventory, the auditor has to report the fact and also report whether they have been properly dealt within books of accounts. Is it correct or incorrect? 2 options. You have 10 seconds to report. This is false. And this is a homework. Anybody can challenge this. Just write it why it is false in the chat box, and we'll see. Next, discrepancies on verification of inventory can be. This has 4 options: pilferage, posting done on wrong card, error in addition and subtraction, all of the above. I think you would be able to make out in 5 seconds. Verification discrepancy can be because of which of these? The answer is evident, all of the above. Next question on your screen. While attending the physical inventory, the main difficulty arises when there are 2 options: small items in large quantity, large items in small quantity. Very tricky question. While attending physical inventory, the main difficulty arises when there are small items in large quantity or large item in small quantity. Answer is quite clear. Small items in large quantity. When large items in a small quantity, it's easy to verify. You can count on your fingers. Next, explanation to be provided for any change in the inventory ratio. If change is very, very simple, and I'm sure it has 2 options: 25% or 20%. The answer is evident. I'm reiterating this again and again. This is 25%. 3 more questions. Which of the following inventories are not observable? Very simple question. And there are 4 options. Goods in transit, inventories held by third party, inventories belonging to third party, all of the above. Out of these, which cannot be observed? Answer is again very, very clear and evident. All of these, as we discussed. Second last question, 2 options. Is it mandatory for companies to conduct their physical verification of inventories as at the financial statements? I told you the technical answer and the practical answer as well. True or false? 5 seconds. It's false. I told you technically it might not be possible if there is no risk and if it is not material, but practically it is largely material and it is always risky. Last answer or question rather, which of the following is a new reporting requirement with respect to inventories in CARO 2020? There are 2 options, whether any physical material discrepancies were noticed, whether any discrepancies of 10% or more in aggregate in each class of inventories were noticed, which is the new requirement. And I had given that table also where left side something is written and in the middle something was written. And as a remark, I had given a difference between the 2. Very clear, it is answer B. The term material was written in the previous set of CARO, and now 10% or more for each class of company, each class of inventory has been added. This is a new requirement. So with this, I'm done. This is my contact detail. And if you have any query, please write it down or raise. Now I'm happy to address to the extent I can, depending upon the time. Or as I mentioned, if it needs any further research, I would be happy to do it and get back to you tomorrow itself.
Thank you so much, ma'am, for such a detailed and wonderful deliberation. There are certain questions. First question is the very with your last slide only. So member is asking, is this 10% is suggested by the guidance note?
No, that is under the CARO itself. CARO ka requirement hai.
So according to CARO, it is 10%, no?
Yes, sir.
Okay. One question is, ma'am, what is the disclosure requirement for slow moving or non-moving or damaged and obsolete inventories identified during the audit?
So as per CARO, there is no separate disclosure requirement for slow moving or damaged item. Basis the identification of those kind of inventory, the management together with the auditor or by themselves, they have to make an assessment if there is any need to make any provision for obsolete inventory and bring that impact in the financial statements. And if that impact is material enough, so as a matter of principle, if something is material, then we need to disclose.
Ji, madam. One question is regarding to the while audit of the sample check through sample check. So for inventory discrepancies found for a sample unit, can we explorate these shortages to the whole population?
Sir, it depends. So say for example, there are 100 items and I picked up a sample of 5 and I found everything to be correct. I can even dare to extrapolate it, provided I'm continuing with that client and I have a similar experience in past that inventory always found to be correct. I can very well extrapolate. But in a total population of 100, I picked up 5 items as sample. 2 were incorrect, third was incorrect, and remaining 2 were right. I have to definitely increase my sample size and see what is the accuracy level. So it is absolutely depending upon the situation, nature of the item, risk covered, my continuity with the client, what is my experience related to other items, then I can extrapolate that. It's not only one item or one kind of observation I can conclude that item that I can extrapolate.
Yes, ma'am. Yes, ma'am. As far as the receivables and payables are concerned, if receivables or payables amounting are more than 5 years old and parties are not confirming balances, what is the reporting platform and what provisions are required in this particular case?
Sir, first of all, I have to identify whether it's the Ind AS compliant company or not. So let's talk about, we haven't covered trade payable, so I will not be talking about it.
Yes,
So
yes.
first of all, we'll cover trade receivable and try to address trade payable also. So with respect to trade receivable, first of all, I have to identify whether it's an Ind AS compliant company or non-Ind AS compliant companies, because the provisioning with respect to old age receivable will depend upon which nature company it is. It is Ind AS or non-Ind AS. If it is non-Ind AS, the rules are very different, and if it is Ind AS, the ECL model will come into picture. So depending upon its age, the confirmation which companies or the auditors might have floated to that company, depending upon everything and the conclusion thereon, whether there is a need to provide for loss for impairment, and I will provide for provision for doubtful debts or loss impairment as per the ECL model for Ind AS compliant companies.
Yes. Is it necessary that we have strictly adhere to the provision? Since even in case of a single debtor or creditor, the amount outstanding for few bills may more than 6 months and other less than the 6 months and so on.
Sir, Schedule 3 requires to provide the data in the specified format, in the specified bucket. Even if I have very few, I have to give the entire disclosure, and whatever is not applicable, I have to write nil or I have to provide a dash. So that is a need.
Yes, madam. Last question, ma'am. Trade receivable are subject to the confirmation and inventories as a certain value and certified by the management, and we have relied on such certificate only. So how for this clause in audit report save us?
So that means the auditor haven't done any procedure. They have just relied on the management representation. That's what the question is.
Yes.
No, sir, that is not sufficient, because management representation can only provide me a supportive audit evidence. It cannot be an absolute audit evidence for me to verify or to rely upon. As an auditor, I am bound by my professional standards, which are auditing standard, and I have to perform all the procedures which are dictated by the auditing standard. And auditing standard says that together with performing audit procedures, you can take management representation letter. So only obtaining management representation letter will not suffice, and I have to perform those procedures.
We have to perform these procedures.
Yes, sir.
So thank you so much, ma'am, for such a wonderful deliberation.
Thank you so much, sir.
With the presentation. On behalf of AASP of ICI, I extend my heartiest thanks for sparing your
valuable time. Thank you so much, sir. Thank you so much. And thanks again to provide me the opportunity again to be part of this event, and hope I could do justice to the time given and the topics given.
Yes, ma'am. Thank you so much. Thank you so much.
Thank you, sir. Thanks.
So moving on our next technical session relating to the audit consideration while trade payables and deferred tax, we have with us the eminent speaker, CA Pankaj Tiwari ji. May I share with all of you the brief profile of Pankaj ji. Pankaj is a qualified chartered accountant in May 2012. He is currently involved in the audit and assurance services along with the consultancy services like due diligence, valuation, etc. And previously worked with BSR and Company LLP in the financial service segment, and his specialization in the audit of banks, NBFC, HFCs, and other listed companies like ICICI Bank, Axis Bank, Citibank, Dutch Bank, Vijaya, Union Bank of India, GIC Housing Finance. He has handled under various GAAP, Ind AS, IFRS, US GAAP, and IGAP of listed and unlisted companies in India. He is a member of AASB study group as well as on the expert panel of AASB on the bank audit, and he has contributed a lot in the various publications published by WRC, like statutory audit of bank branch audit, like WRC's background paper on concurrent audit of banks, Versailles branch bank audit on Companies Act, as well as Versailles branch newsletter relating to the banking corner. And he's a regular speaker on Ind AS, Companies Act, and other topics at various forums of WARC, BCAS, and various study circles of various regional council, as well as the various chapters at Institute of Chartered Accountant of India. So I welcome you, Pankaj ji, on this 57th VCM organized by AASB of ICI. So I request you to please deliberate on the topic of relating to trade payable and deferred tax. Over to Pankaj ji, please.
Thank you, Anilji, and I hope you can see my screen and you can hear me clearly.
Yes, perfectly fine.
Yeah. And thank you, AASB, for organizing this seminar, a well-timed seminar, especially when all listed companies have closed their financials. And now we are moving it to the small entities where wherein, all small practitioners are involved. And I am very sure that the topics or the chapters which have been picked up by the AASB will help all the participants to carry out their audit in a in a better manner as compared to what we were auditing in the previous time. So I think the topic which have been given to me deals with the trade payable and deferred tax. So I will deal with the deferred tax first, considering this is the the importance of the chapter or the importance of the topic, and then I'll be coming to the trade payable. So moving on to the so what is my discussion point? So briefly, if you look at the presentation, I will be discussing these 4 points in next 45 minutes, 60 minutes. First, we will be discussing a brief about the item of the financial statement, whether it relates to deferred tax or it relates to the trade payable. What all about the deferred tax? What are the various requirements of AS 22 or Ind AS 12 in a brief manner? Because obviously this is not the accounting standard session. This is typically how do you audit the deferred tax. And again, I will be discussing a little bit about the trade payable. What are the recent challenges in the trade payable? Then we'll be discussing more on the 3 key points, which are relevant audit assertions, which are applicable to both these items of the financial statement, which is deferred tax and the trade payable, the relevant standard auditing, which as an auditor, while auditing these, the items of the financial statement, we should be aware about. Some key audit procedure we'll be discussing about for these items. And then at the end, after understanding everything, what is my reporting responsibility as an auditor, or what is the requirement by the auditor? So these are the 4 things typically I'll be discussing about for both these items. So let's move to deferred tax. Before we get into the deferred tax, a lot has been said during the introduction session, and which is practically true, because many of the small entities or small companies are unaware that whether the deferred tax is applicable to them or not applicable to them, whether I need to compute the deferred tax, I need to present it in the financial statement, so on and so forth. And not only the the companies, unfortunately some of the auditors have also tend to miss these points. So it's a good opportunity for all of us to get together and learn this aspect. And this deferred tax has become very relevant and very important in the current situation. Why it is very important? One is that in light of uncertainty due to COVID-19, and which we will discuss in detail, that what is the implication of COVID-19 on my deferred tax item, especially post COVID-19. Now the situation have normalized. A lot of discussions are happening in the boardroom with respect to the recognition of this deferred tax item. And let me tell you, my friends, especially based on my experience, this has always been a key point of discussion in the boardroom. And why this is a key point of discussion in the boardroom? Because all of you are aware about the placement of the deferred tax. It starts at the PBT, then you have the current tax and deferred tax, and then you have a PAT. So from the PBT to the PAT, this is one of the items which comes in the financial statement and which has a lot of implication on the bottom line of the company. And it is also important because it revolves around a lot of judgment by the management, a lot of estimation by the management. And that's why it becomes very important for us to understand this concept. Also, many of us, the deferred tax, it requires a little knowledge about the taxation as well. So even though we are aware about the auditing standard, accounting standard, but when you move to the deferred tax, it involves a little bit knowledge of the taxation law as well. And as I said, it impacts the P&L, it impacts the net worth, it impacts the reserve of the company. How it impacts, we will discuss it as we go ahead. So considering these points, this becomes a very important item in the financial statement, whether as a management or as an auditor. Now, before you understand that how do you audit deferred tax, let's understand the element of deferred tax, because I need to just break it up between what all items I need to audit to arrive at a conclusion whether the deferred tax asset is correctly reflecting in my financial statement, or whether the deferred tax asset is giving a true and fair view in the financial statement. Because if you're what I'm trying to do by auditing this deferred tax number, I'm trying to ensure that because of this recognition of deferred tax asset, my financial statements are not materially misstated. That's what I'm trying to do at the end of the day. So what are the important factors which one should be aware about while auditing the deferred tax number? One is that the deferred tax gets originated only if there is a difference between the accounting books and the tax books. That means you should have a difference between the accounting books, what you have debited to the P&L, and what you have claimed in your tax books. So first, first point for as an auditor to understand is whether there is a difference between accounting books and tax books, and how do you identify difference, how do you verify difference, so on and so forth. The second, a major important role is played by the tax rate, what has been considered for the deferred tax purposes. And we will discuss about it in detail, that what all audit procedure one has to do to get the comfort on this tax rate for the deferred tax item. Third is the criteria for recognition. There is a lot of condition which have been put up by both AS22 as well as the Ind AS 12 with respect to the recognition of deferred tax, especially the recognition of deferred tax asset per se. So we should be aware about that. The last is reassessment of deferred tax asset particularly. The standard talks about that once you have recognized a deferred tax asset in your financial statement, it's not a static, it will not remain constant. It need to be revisited every year basis. So these are the four factors which primarily an auditor should understand, which primarily an auditor would audit to get a comfort on the deferred tax number in the financial statement. Now, little bit concept here and there we should understand before we move to the auditing part. First, if you go to AS22, as I said, there has to be a difference between the tax books and the accounting books. Now, the tax books and the accounting books in the earlier days, that means in the accounting standard, we still call it as a timing difference. That means what my taxable income and what my accounting income, there is a difference, and this difference is being capable of reversal. That means this difference will reverse in the future, and basis which I will create my deferred tax asset or a liability, so on and so forth, depending upon what kind of difference it is. Then there was a concept of something called as a permanent difference, which we normally used to tend to relate that there is no requirement to create any deferred tax asset or a deferred tax liability on that particular point. This was a stone age, I can say, AS22. Still many companies have this kind of a concept, which are the companies which are falling under IGAP, and especially those companies which are adopting the division 1 of schedule 3. Second, in the current Ind AS concept, the timing difference has been changed to a temporary difference, mainly because what they try to say that you go by the balance sheet approach and not by the P&L approach, which normally was there in the case of AS22. They say that what you do, you compare accounting base versus tax base, you compare your account balance sheet versus tax balance sheet, and you see whether there is any difference between the two. If there is any difference, the difference could be taxable, could be deductible. In accounting standard 22, when we used to look at it, this kind of concept was not there. This was there more particularly in understanding. Like, for example, if I have not been allowed to claim certain expenditure now, I will be claiming certain expenditure in future. In AS22, this was not given any name, but under Ind AS 12, this has been called as a deductible temporary difference. That means you will get deduction in the future. So the deduction which you will get in the future, the items which will reduce your taxable income in the future are called as a deductible temporary differences under Ind AS 12 regime. And taxable temporary differences are mainly those differences wherein these will be added to your taxable income. That means the entity need to pay certain tax on these items in the future, which we will be called as a taxable temporary differences. So these are typically the two differences which have been called out. Earlier, AS22, no issues, only timing and permanent. Now the concept is temporary. You have two kind of differences, taxable and deductible temporary differences. And the major change which I can see is, comparing a tax balance sheet versus accounts balance sheet. So that's a major change which is there under the Ind AS 12. So these are the few primarily concept under Ind AS 12. Now let's move to the auditing part of it. Now we have understood what are the factors which are there under the deferred tax. You have 4 factors which you have discussed. We have understood that what are the various concepts under deferred tax. There is something called as a timing difference, permanent difference. When I'm auditing an IGAP company, there is something called as a temporary difference when I'm auditing a Ind AS company. And that temporary difference could also be further breakdown into a taxable and deductible temporary difference. Now, how do you audit these things, right? I mean, that's the primary question. How do I audit? So first is that deferred tax is a account balance level assertion. What do you mean by this? There are two kind of assertions, and let me tell you, my friend, assertion is very underrated word in today's situation. I mean, many of especially the small medium practitioner, uh, in absence of understanding of these audit assertions, sometimes we try to do over auditing, or sometimes we try to do under auditing. So that's why my request, a sincere request to all of you will be that please understand these audit assertions and plan your audit according to these audit assertions. It will give you enough document, it will give you enough evidences to comply your standard auditing requirement. Now let's understand what do you mean by account balance level assertions. There are some assertions, or there are some items of the financial statement where we do some procedure checking. That means what? I will do test of control. I will evaluate the internal financial control which are there, which are adopted by the management with respect to an item of financial statement. Let's suppose you're auditing an expense. When I'm auditing an expense, I will go and I will verify the controls which are revolving around the booking of the expenses. Or when I'm auditing a sales, I will go around and check whether what are the controls which are relating to the sales part. However, when it comes to the deferred tax item, this is not a account. This is not a something called as a accounting. This is not a some procedure aspect. This is completely a account balance which is there in the financial statement. So I will not do any test of control. I will not do any test of detail. What I will do is exactly a substantive procedure, which means I will evaluate or I will audit the number which is presented in the financial statement, which will involve me identifying what are the differences, seeing what are the tax rate which have been used, seeing what is the management estimates which the company has made while recognizing the deferred tax asset and deferred tax liability. And what are the various audit assertions which as an auditor I will evaluate? 3 audit assertions I will evaluate. Audit assertions basically gives you a strong documentation, or these are very strong procedure which can help you in auditing the number. One is valuation. Now you'll ask me that what is valuation in deferred tax asset? Valuation always does not mean arriving at value of a particular item of a financial statement. It means whether the number has been correctly reflecting in the financial statement. That means whether the deferred tax asset is correctly stated in the financial statement. So first I will try to get my comfort on that part, that whether the number has been correctly computed. Number 2, rights and obligation. What I will check in rights and obligation, I will see that whether the company has sufficient future taxable income to utilize this deferred tax asset. That comes under rights and obligation. Then presentation and disclosure, all of us are aware about. There are a lot of disclosure which need to be given with respect to the deferred tax assets in the financial statement. I will be auditing those disclosures. So 3 things I will be auditing to address these audit assertions. What are the various standards on auditing which are applicable to these for auditing the deferred tax asset? So I call them a very specific standard on auditing, and there are some journal audit, some common standard on auditing. Which are they? I will be looking at SA 330, which is auditor response to assess risk. I will be looking at SA 540, which is auditing the accounting estimates. I will also be taking guidance from SA 500 and SA 240, which I normally take in any audit of the financial statement. I mean, whether I'm auditing inventory, whether I'm auditing trade receivable, whether I'm auditing trade payable, whether I'm auditing any items of the financial statement, I will be taking the guidance from audit evidences and audit documentation, which primarily tells me that what kind of audit evidences I should obtain and how should I audit my documented, or how should I do my audit documentation. So those are very common standard auditing which is applicable at all level. With respect to the specific standard auditing, what I will be evaluating. So I will be doing a verification. As I said, I will be doing a substantive audit procedure, which means what? I will be verifying the recognition of DTA and DTL. That means I will be verifying whether these differences between the accounting books and the tax books are in the nature of permanent differences, or in the nature of timing differences, or whether they're in the nature of deductible temporary differences, or they're in the nature of taxable temporary differences. That's the first level of checking I'll be doing it. And before SA 330, my friends, all of you must be aware about, there is something called as a SA 315, which is assessing the audit risk, assessing the risk of the misstatement. That means I will be evaluating what is the level of risk I'm running with the deferred tax asset, whether this is a high risk area, low risk area, or the medium risk area. If it's when it will be a high risk area, when the deferred tax asset amounts to a significant item or a significant item in my financial statement. That means if my total asset is worth rupees 100, 20, 30 rupees is coming out of a deferred tax asset, then it becomes a high risk area for me. I need to look at it more carefully. And then I will be designing my audit procedure as per 330. So first you will do, you will identify the risk as per 330, then you will address those risks as per 330. Identifying the risk as per 315 and addressing those risks as per 330. One is designing the audit procedure. Second is perform the audit procedure to evaluate the presentation and disclosure. So with respect to deferred tax asset, I will not only verify or audit the numbers which are there in the financial statement, I would also be verifying the disclosures which are made in the financial statement with respect to deferred tax and deferred tax liability. And any of you or most of you might have gone through the QRB observation or FRRB observation, which are published by the institute. The major observation were relating to these two items. First, the deferred tax asset were not correctly recognized or deferred tax liability was not correctly recognized in the financial statement. The disclosures was not given properly in the financial statement by the management, and even the auditor didn't look at it properly. So these kind of observations are there in the QRB reports or in the FRRB reports also. So we should be looking at what are the various audit procedure one need to look at it while auditing the deferred tax asset. SA 540 is one of the auditing standard which I say has gained its primary relevance when the Ind AS has come up. This standard talks about how as an auditor I should audit the account estimate which have been made by the management, the judgments which have been made by the management, because as I said in the beginning, the recognition of deferred tax asset based on the future taxable income, 110% involves a judgment by the management. How do I audit that judgment is being prescribed in SA 540. What questions should I be asking the management? How I should be relying upon the auditor expert when the management has employed some expert to evaluate what will be its future income. The auditor should evaluate the reasonableness of this significant assumption. That means what? If the entity is projecting the 20% growth year on year basis to say that I will be able to recognize a deferred tax asset in current year and I will have a future taxable income in the forthcoming year, the auditor should evaluate the reasonableness of these assumptions, whether these assumptions are as per the industry standard, whether these assumptions have been achieved in the past, so on and so forth. This guidance has been given under SA 540, and that's why it becomes very relevant as an auditor to understand how do you audit these judgments or assumptions which are made by the management, and the disclosure of these estimates or judgment in accordance with the financial reporting framework under Ind AS 1. Many of you who would have worked on the Ind AS financial statement would be aware that one of the area where the management discloses its judgment is a deferred tax item, because of its peculiar nature, it's having an uncertainty around it, and that's why if you are auditing a balance sheet which is under Ind AS, please make sure that the management has disclosed this judgment of estimating future taxable income or future taxable profit in the financial statement. Now, having understood the factors which are revolving around deferred tax, having understood the assertions, having understood what are the standard of auditing to be applied, let's come to the specific audit procedure which as an auditor we should be looking at it. Number one, as I said, we should be doing a verification of timing or temporary differences. That means whether the management has considered correct timing differences or correct temporary differences. Whether the because if this is the starting point of recognition of deferred tax asset or deferred tax liability. If you have gone wrong over here, if the management has gone wrong in identifying temporary differences or timing differences, then the whole computation of deferred tax asset will go wrong, and consequently the disclosure. So that's why it is very relevant for us to identify or to audit the nature of these differences. Now, one will ask me that how do I look at it? I mean, how do I start with it? Let me tell you my practical experience. I would like to share here. Pick up the tax computation. I can understand the tax computation in large entities may not be ready at that point of time. But in smaller entities, in mid-sized private limited companies, many of these things are done together. Pick up the statement of income, SOI, wherein a lot of allowances and disallowances have been done in the computation. That should be the starting point to identify if this disallowance have been done, whether this amount to a deferred tax asset or a deferred tax liability. Before that, whether any differences when I'm disallowing a particular item in my tax computation, whether it creates any difference between an accounting books and the tax books, and whether this difference is a timing difference, permanent difference, temporary difference. If it fits into any of the category except permanent differences, you will again test it for deferred tax asset or a deferred tax liability. So you should be very clear that from where to start, how do you pick up the items, and how do you look at it. And especially what you need to see is that whether this difference will reverse in the future. A very important concept one need to keep in the mind, it should reverse in the future. That doesn't mean it should reverse in the next year. It can reverse in next year, it can reverse in 2 years down the line, 3 years down the line, 5 years down the line. One need not ascertain or determine the timing of the reversal. What you need to determine is that whether this will reverse in the future or not. Like for example, provision for warranty. I might keep on adding provision for warranty in my books of accounts, but I would be also paying it off, right? I'll be incurring certain expenditure with respect to those warranty. So I would not be able to do one-to-one match with respect to the provision, the actual expenditure incurred. But what I would be able to do is that I'll be able to say that these are getting reversed in the future. A second example is provision for gratuity. I would not be able to say that per employee how much provision I made and per employee how much payment I made, and whether there is a reversal or there is no reversal. So what I'm trying to highlight over here is that the timing of reversal should not be known, but it should be reversible in the future. Now, when it comes to the Ind AS, as I said, the concept is very different. You need to take account base, you need to take tax base. What do you mean by account base and tax base? Now, if I look at the loans, my account base and tax base, there will not be any difference in the loan. I'm putting is very simply because one may have a EIR concept into this. We are not getting into that technicality, but to put a very simple, I'm saying in case of loans, there would not be any difference between the account books and the tax books. When I say I have given a loan of 100,000, I will recover 1,000 here, I will recover 1,000 in my tax books also. But when I say about the ECL provision, my account base, I would have debited my P&L account with 100 rupees, but they may not be allowed under tax base. That means in tax balance sheet, this provision may not be there. In account balance sheet, this provision would be there. So that's where the difference gets created, which would be tested for your deferred tax asset, deferred tax liability, taxable and temporary differences, so on and so forth. So first, this is how you should be auditing, or this is how you should be verifying the timing or temporary differences. It becomes very important, as I said in the beginning, because if you are going wrong over here, then the rest of the arithmetics of the number. So be very clear, start with the tax computation and understand what are the differences which one need to look at it. Second is that verification of determination of tax rate. A very important concept in today's situation, especially when you have a multiple rates applicable to corporates. Now, both under Ind AS and AS, it says that the rate which have been enacted or substantially enacted by the balance sheet date. I am sure there is no issue with respect to this because we don't have any, such kind of, technicalities now. But when you are looking at the deferred tax asset, or whenever you have the difference between the account books and the tax books, and you need to compute the deferred tax asset, as an auditor, I should be looking at what rate the management has used. Because as you are aware, the currently the corporate tax rate depends upon whether you are a domestic company, whether you are a foreign company, whether there is a separate rate which are applicable on total income, there is separate rate applicable based on the total turnover, and there are various options which are given by the income tax authority to the entities which are availed by the corporate. So be very clear what rate you are using. It should not be the standard rate which is given in the Income Tax Act. It should be the rate which the company itself is using for paying the tax liability. So as an auditor, I should be verifying that tax rate. Second is that, and this is what I have seen, at least in my practical experience, that whenever there is a shift in the rates, that means earlier I was paying the tax at a higher rate because I had a MAT credit entitlement. Now I have utilized those MAT credit entitlement. I'm moving it to a normal tax rate. Typically what the company used to do, they used to just compute the current year deferred tax asset as per the new rate. But that's not correct. You need to recompute the whole deferred tax asset which is of current year and the previous year as per the new rate. So you will have to recompute the whole deferred tax asset and liability based on the new rate as on today. And the difference, whatever will be there, will be debited to the P&L account. This is an area of error which I have observed in many entities. And I would request all of you that if your company which you are auditing has changed its rate in the current year, please look into these aspects. The second is that, and this is a very important point, which is in special consideration in case of loss-making companies. And this is a concept which have been discussed day in and day out. And this becomes very important in case of COVID situation. And especially when we had a 2 years of COVID period, where many of the entities were reporting losses both under the accounting books and under the tax books. And especially now they would be getting up to recognize a deferred tax asset on these, on these losses. So with respect to the loss-making entities, one need to be very clear when you can recognize a deferred tax asset. And I would discuss in detail what is the reason by the standard setting authorities to put so much restriction on the deferred recognition of these deferred tax asset. So under AS 22, if you have a reasonable certainty, you can recognize the deferred tax asset, no question at all. But if you have a carry forward losses or you have an unabsorbed depreciation, you require a virtual certainty. What do you mean by virtual certainty? All of you are aware about, you require some convincing evidence. You require some concrete plan in hand to prove that you will be able to use these deferred tax asset or offset these carry forward losses and absorb depreciation in the future. Now, how much it was practically possible is everybody's, everybody's aware about it. And that's why if you look at under Ind AS 12, this has been little toned down. I would not say completely removed, but it has been little relaxed under Ind AS 12. Now they say that, and now I think they have made it very practical. Let me tell you very frankly, what they have said that now there should be only a probability that there will be a taxable profit in the future. Now, how do you establish the probability? They have given certain criteria, or they've given certain condition that if you comply 1, 2, 3 points, you will be able to recognize a deferred tax asset. Like for example, one of the criteria is that there were some causes which are unlikely to occur in the future. Like for example, your demand in the market, or you had incurred huge expenditure in the initial period because of your advertisement or because of the branding expenses, so on and so forth. And now you have established in the market and you need not incur these kind of expenditure. So these are the causes which are unlikely to occur in the future, and you might recognize a deferred tax asset on the losses. So what I'm trying to highlight over is that as compared to in the AS 22, Ind AS 12 is more practical. And that's why when you are auditing a company which is under AS 22, or when you are auditing a company under Ind AS 12, you need to look at the relevant standard, because as compared to Ind AS 2, AS 22 is more stringent, because it asks for a convincing evidence, or it asks for a foolproof plan before you recognize the deferred tax asset. And this has been based on my practical experience. This has been an area of discussion with the board of directors, with the senior management, considering the COVID situation in last 2 years. You have a huge accumulated tax losses which are sitting into your tax return, wherein the entity want to recognize a deferred tax asset on these items. And both these AS and Ind AS restrict the recognition of deferred tax asset mainly because it has a direct impact on the net worth and reserves of the company. And let me tell you how. Whenever, I'm sure practically all of you have dealt with the deferred tax asset. When you recognize a deferred tax asset in the financial statement, your accounting entry or your journal entry is credit to P&L and debit a deferred tax asset. That means one leg is going into a credit to P&L, which will flow back to your reserves and surplus schedule, which is balancing surplus in P&L account. Another is sitting in the deferred tax asset. So it on the liability front or on the reserve front, it increases my reserve and increase my assets. So one, if typically looks at the balance sheet, he will look at there is a high reserve, there is a high net worth with respect to the company. And it's a gray area, let me tell you. When you look at the definition of a net worth, nowhere under the Companies Act, there is a specification or there is a requirement to remove the deferred tax assets. I can understand there are prescribed formats by various regulators which requires you to remove deferred tax asset while computing the net worth. But under the Companies Act, it is not specifically mentioned that you need to remove the deferred tax asset from the computation of net worth. Second, when the dividend is to be paid out of the free reserve. Now, dividend will be paid of the accumulated profit which is sitting in my balance sheet. And again, section 123 does not specifically require you to reduce the deferred tax asset while arriving at the free reserve of the company. So that's why, my friend, it becomes very important. And that's why there is a lot of restrictions which have been put up by the accounting standard, both under AS 22 and under Ind AS 12, while recognizing the deferred tax asset. And that's why, as an auditor, we should be more careful in auditing these numbers. Now, let's look at this case. This case is very simple. This is a new company which was set up. It has incurred a significant losses in the first year of operation due to reasons such as advertisement, initial setup costs, so on and so forth. And over the years, there is a significant increase in the operation, and the costs have normalized also. Further, they have also raised certain capital, repaid its borrowing, so on and so forth. So now the company is under a very favorable position. They have sufficient profits in the current year. However, these nature of business, last line if you read, the nature of business is not such that they don't have any binding contract. Now, here the difference comes when you are looking at under AS 22 and under Ind AS 12. As an auditor or the management would like to recognize deferred tax asset both under AS 22 and under Ind AS 12, whichever the framework the company is reporting. But when I, as an auditor, sit on the auditor's chair, I need to look at it whether the AS 22 conditions have been complied with. Now, if you look at it, typically under AS 22, you require a virtual certainty, you require a convincing evidence, which ultimately require that you should have a binding contract with the parties. Now, in this particular situation, the binding contract is not possible because the nature of business is such that. Now, under AS 22, the management might want to recognize the deferred tax asset, but as an auditor, we have some hesitation in recognizing deferred tax asset. But under Ind AS 12, both the management and the auditor can go ahead and say that the deferred tax asset recognition under Ind AS 12 is well within the framework. So what I'm trying to highlight over here is that the estimates or the judgment which are made by the management should be very clearly audited and should be very clearly reviewed by the auditor as per SA 540. Some cases you might agree with the management, some cases you might not agree with the management. So first, what we looked at is that we should be looking at the differences. We should be looking at what tax rate has been used by the management. Then we should be looking at it that what are the various judgments which have been made by the management. The another issue comes up is that verification of reassessment of the deferred tax asset. Both under AS 22 and under Ind AS 12, what you need to do is that you need to reassess these deferred tax assets which you have recognized in the balance sheet. Because what you need to see that whether the future economic benefit is available against this deferred tax asset. That means I would have a sufficient future taxable income against which I can set off these losses which are there on which I have recognized the deferred tax asset. And if you are not able to comply with these conditions, you need to write down those deferred tax assets. And auditor need to review such reassessment of write down and reduction and subsequent reassessment as per SA 540. So what it means is that once you have recognized or once the management has recognized the deferred tax asset, it does not mean that they need not reassess this. As a management, as per AS 22 and under Ind AS 12, there is a requirement to reassess this deferred tax asset on a year-on-year basis. And as an auditor, I should evaluate the management assessment, whether it is correct or not correct. On what basis I will assess these estimates? Simply whether the future economic benefit is available to the management or not. If there is no future economic benefit, ideally it should be reversed in the financial statement. The other point which I will be looking as a auditor is that material uncertainty relating to going concern. And this is a peculiar case which I just had closed the financial statement last week itself, wherein as per 570, the auditor are required to assess the going concern of the company for next 12 months, that whether the company will be able to survive, whether the company will be able to repay its debt in the next 12 months. Further, the new Caro clause in 2020 also requires the auditor to comment upon the going concern based on some financial ratios, etc., etc. Now, if I'm saying as per 570 and both under Caro that the company will not be able to, repay its debt or will be able to run within next 12 months, whatsoever the reason, whether it's a financial reason, operating reason, or the financial ratios are not giving a promising picture, I would relook at it, the deferred tax asset in the financial statement, because I would not have any future taxable income. So that means what? If you as an auditor are concluding that the company, there is a material uncertainty relating to going concern, either in the main report or under the CARO, you should also look at it whether the recognition of deferred tax asset in the financial statement is correct or it should be reversed. In one of our clients, we had this kind of an issue and we had reversed the whole deferred tax asset in the financial statement. Now, if you tell me that, okay, if you reverse the deferred tax asset, what should I do? Let's suppose tomorrow, if the company is able to run within next 12 months, and in the next year, the company is performing, the profits are made by the company, so on and so forth. Again, both the accounting standard, AS 12, AS 22, and Ind AS 12 gives the option for reassessment of unrecognized deferred tax also. But for current year, these deferred tax assets should not be an item in my financial statement if there is a material uncertainty relating to going concern. Please look at this aspect. This is a very relevant aspect in the today's situation. Now, coming to the another part which is there, and let me tell you, these are very specific audit points which I'm discussing, or audit procedures which I'm discussing, which as an auditor we should keep in the mind. Post COVID-19 situation, as I said, a lot of companies had reversed the deferred tax asset in the financial statement of March 20 and 21. Now post 2022, I mean, now the situation is normalizing. There's an improvement in the business conditions and the business environment. Many entities are now trying to evaluate whether they should bring back the deferred tax asset in the financial statement because they project a future taxable profit. So as an auditor, what is my responsibility? As an auditor, again, I will go back to SA 540. I will evaluate the management judgment. I will obtain the necessary evidences. What do you mean by necessary evidences? Whether there is a, whether the, what the management is trying to say, whether it is there in the market. If the management is trying to say, I will be having a growth of 20% and the sector in which they are operating is not, looking promising in based on the market information, so on and so forth, or there are still supply chain issues with respect to those companies, that means the management judgment is not correct and they will not be, and as an auditor, I should now allow them to recognize the deferred tax asset in the balance sheet. That's my responsibility as an auditor, basis SA 540 analysis. And if you are under Ind AS 12, then you go and look at those specific conditions which have been prescribed over there. So this is a very important area of a debate with the management in the current year, that post COVID-19 situation, whether I should recognize a deferred tax asset or I should not recognize a deferred tax asset. Now, there are a lot of disclosures which have been given by the management. I will quickly run through. Just make sure these disclosures are there in your financial statement. One, if you are under Ind AS company, you need to give the estimates and judgment, as I said in the beginning. If you are under Ind AS 12, you need to give, like for example, on the left-hand side, you need to just give the breakup of current tax and deferred tax asset. Then you need to give a tax reconciliation, which is unique in Ind AS companies. It is not there under the IGAAP companies. Now, if you look at this, what they're trying to do under this reconciliation, they're trying to pick up the profit before tax. They're trying to multiply it with the tax rate, what is applicable to the entity. And they're saying that this is the expected income tax I should be paying, but I have paid less. So what is the reconciliation of that has been put up by the entities. And this is a requirement under Ind AS 12. It is not there under the IGAAP. Again, what I need to disclose under Ind AS 12 is a movement of deferred tax asset. That means what was the opening, how much I recognize in the P&L, how much I recognize in the OCI, and what are the adjustments, and what is the closing balance. So typically, opening closing analysis I need to give. Primarily, I need to give this under Ind AS 12, not under the AS 22. The last disclosure which I need to give, the breakup of deferred tax asset and a deferred tax liability, which ideally depicts that what are the deferred tax, what are the nature of items which have resulted in deferred tax asset, what are the nature of item which has resulted in deferred tax liability. So these kind of disclosures are to be given in the financial statement. One important point which I would like to highlight to all of the members or the participants who are attending. Now the MAT credit entitlement is a part of deferred tax asset. So please request all of you, if your entities are reporting under Ind AS, MAT credit entitlement should be reported under the deferred tax asset and not as a separate line item in the financial statement. Please be careful, and if your entity has not done it, please ask them or request them to make that change. Now, having understood what are the various audit procedures which an entity need to do, which an auditor need to do, what are the various factors which an auditor need to consider, like for example, we discuss about the specific loss situation, we discuss specific with respect to the COVID-19, post-COVID-19 pandemic, and reassessment of deferred tax asset. Now, having understood all of this, what is my requirement to report? Because all the audit procedure, what I did, I need to report somewhere, right? As an auditor, I need to opine on these things. Now, one, there could be three situations. One, after auditing and applying all the audit procedure, you consider that the deferred tax asset is not correctly computed as per AS 22 or as per Ind AS 12. Simple, go and modify your opinion. If you think that this is the financial statement does not reflect a true and fair view, considering the materiality concept obviously in the mind. Another is that, okay, I understand that deferred tax assets have been correctly recognized in the financial statement. However, there is a little bit uncertainty, and I have relied a lot of management estimates and judgments, so on and so forth. So what should I do? As a matter of fact, what any auditor can do, they can write a key audit matter. They can include a key audit matter in their auditor's report. Primarily, these key audit matter are applicable for the listed entities primarily, but there is no harm in putting for unlisted entities also. There is no such restriction. So what I can do, I can include a CAM. What does the CAM say? The CAM says that what are the risks you have identified with respect to the deferred tax asset, and what are the audit procedure which you have carried out to address those risks. This is the one way the auditor can communicate to the user of the financial statement that what are the various audit procedure he has carried out with respect to this deferred tax asset item, which he thinks is a significant in auditor's judgment. Or the second option is that you can include an emphasis of matter paragraph in your auditor report, where you think that the matter is such an important, or the matter is of a great importance, that you would like the user of the financial statement to look at the deferred tax asset or a liability. So what you can do, you can include a EUM paragraph in your auditor report. Let me tell you, my friend, and this has been repeated many a times, EUM is not a substitute for qualification. Don't say that that the management has recognized with this deferred tax asset, however, as an auditor we do not agree, so on and so forth. The EOM is just for an information to enhance the reading or to enhance the information of the user. It is not a substitute for the qualification. So please be restrict. If you have a modification, please go and report as a modification. Some illustrative for all of you to see. Like for example, in this is a case of a bank where deferred tax assets were recognized. Still there were losses, book losses were there, huge book losses were there, and the deferred tax assets were recognized. So as an auditor, we had given a CAM over there. And this is a CAM which depicts that why we have recognized this as a CAM, or why we are considering it as a CAM, and what are the various audit procedures what I have applied. Again, a second CAM which was given by one of the auditor is that on the MAT issue. So as you are all aware, the MAT is now a part of a deferred tax asset in form of an unutilized tax credit. So they said that because the assessment, if you read the highlighted part, because the assessment process involves judgment regarding the future profitability and likelihood of realization of these assets, whether taxable, support the recognition. This requires assumption regarding future taxable profit, which is inherently uncertain. Accordingly, the same has been considered as a key audit matter. So what you need to do, you need to write that why you have considered the key audit matter and what are the various audit procedure you have done. So one is that you can give a CAM on the MAT or on the deferred tax asset recognition. Second is you can draw the attention of the user by way of an emphasis of matter paragraph. This is an emphasis of matter paragraph in case of one of the big private sector bank which went into debacle in 2020. So there the bank has assessed that there is a reasonable certainty that sufficient future taxable income will be available against which such deferred tax asset can be recognized. So the auditor in this case had given a EOM, and the EOM, as you all are aware, supported by a management note. And below I have just put the management note where the management is saying that they will be able to have a taxable income in the future against which they can recognize this deferred tax asset. So this is the other way, my friend, by which you can report either in the CAM or in the EUM. These are the 3 pointers which one need to be aware about. that with respect to the recognition of deferred tax or with respect to the auditing deferred tax. First, you verify the compliance of financial reporting framework, whether it is AS22 or under Ind AS. Then you obtain and document the audit evidence under 315, under 330, and under 540 as well. Then you report in the independent auditor's report after evaluating whether whether you want to report as per 701 or you want to report as per 706. So these are the items which one need to look at it, or this is the way you need to audit, or I can say get a comfort on the number or on the figure of a deferred tax asset which get reported in the financial statement. Please pose your questions in the chat box. I will quickly run through the trade payable. A very important point I will discuss because most of the point was already discussed along with the trade receivable trade receivable session also. So first of all, let me make this confusion very clear, because a lot of presentation or seminars wherever we spoke on these topics, many people ask me question that what do you mean by trade payable? I mean, what you call it as a trade payable? So very clearly, my friend, this guidance has been given under Schedule 3. A payable shall be classified trade payable if it is in respect of amount of goods purchased or services received in normal course of business. So your normal creditor, your normal debtor, which you would be taking the services, would come under trade payable. Your contractual obligation would not come under trade payable. Like for example, they have given certain example. So be very clear that what will reflect as trade payable and what will reflect as not a trade payable, because many of the time when we review the financial statement, we come to know this aspect. So whenever as an auditor you are reviewing the financial statement, please make sure that what items are coming under trade payable and what items should not come under trade payable. What are the various aspects with respect to the trade payable and why this becomes a very important part for us? One point, because as an auditor, I should be aware about what risk I'm running with it with respect to an item in the financial statement. As you are aware, there is a lot of changes in the MSME Act, and there is an increased focus of the regulator on MSME entities. That means payable by the entity to the MSME parties, basically. There is a change in the definition of MSME, which has brought many new entities have come up within the MSME ambit. And the auditor, as an auditor, we should be very much careful that how an entity is identifying the MSME entities. What is their process? What is their plan? Whether they are identifying the MSME at the time of onboarding itself or they are identifying at a later point of a time. Companies Act also and Schedule 3 both have increased, have also given a lot of importance to these MSME. You are required to file a form with the MSME 1 now. So whenever you're making a disclosure under Schedule 3, you need to reconcile whether the parties which you have reported under MSME 1 are appearing under the disclosure or not. So as an auditor, I should be having this audit process in mind. There is a separate disclosure which is provided on the face of the balance sheet also for the MSME entities. And another point which is always an area of a debate for an auditor to ponder upon, whether 45 days. So if you're not paying any MSME entity within 45 days, you are liable to pay interest on that amount. So many of the clients have argued with us that we have a contractual arrangement with the MSME entities that we will pay them within 90 days with the MSME entities have also been agreed. So in those cases, this 45 days rule may not apply. But in other cases, when there is a silent, there is no such contract, make sure that these amounts are paid within 45 days. So as an auditor, I should be looking into all these aspects. The trade payable audit is not only restricted to verifying the aging of the trade payable. The trade payable audit also revolves around all these areas. Another is a fraud risk, which I'm running with it. All of you are aware about there is a risk of fake or fabricated invoices without having any actual transaction. All of you might have read in the newspaper recent GST fraud, which was providing input tax credit to the entities. So these are the areas which as an auditor, I should be very careful in carrying out my audit procedure. Audit assertions, I will not dwell upon much, but these are the audit assertions. One should be looking at it. You should be looking at it, whether your trade payable is complete, whether these trade payable are existing, whether they have been accurately reported, whether they have been reported at a correct amount, whether there is an obligation to pay, and whether they have been presented correctly in the financial statement. These are some of the audit assertions which one should look at it. standard auditing, the most important standard auditing, which I would like to talk about here, my friend, is the external confirmation. And this is one of the areas which I would like to spend some time, even though the time is very limited, that external confirmation as an auditor has been the last priority for us. But let me tell you, my friend, with respect to the increased disclosure in the Schedule 3, we need to look at into more detail. That means because now we need to report whether the trade payable are disputed, undisputed. The management will come and say that no, none of our trade payable are disputed. But when I'm sending the confirmation to the third party, I should be looking into these aspects. And one more important point which I would like to highlight: external confirmation is the must. There cannot be any substitution to the external confirmation process. And you should always send a positive confirmation to the trade payable, my friend. All of you are aware about there is two kinds of confirmation. One is a positive confirmation, another is a negative confirmation. Negative confirmation, normally auditors tend to send because you don't need to wait for the recipient to reply, because in case of negative confirmation, if they disagree, then only they reply. So if they have not replied, I will consider them as a confirmed balances. Please, my request to all of you, and there is a lot of apprehension on this aspect from all the regulator, that you cannot send a negative confirmation, because simple human tendency, my friend. If you are sending a confirmation to third party saying that the company is liable to pay you 200 rupees, and actually that entity is supposed to receive 100 rupees, nobody will reply to you saying that no, I have to receive only 100 rupees, don't pay me 200 rupees. So this is a normal tendency which a human mind has. So that's why I would request you, please don't send negative confirmation. Always, both for trade payable and trade receivable, please send the positive confirmation, wherein you will say that if you have not received the confirmation, you will apply alternative process. You will not just assume that these balances have been confirmed by the third party. Now, what are the various audit procedure? Quickly, obviously, I will do a test of internal financial control on the trade payable. That means I will carry out the whole control testing process with respect to booking of the invoices, booking of the inventory in my books of accounts, and then trade payable. And I will also do a cutoff procedure. Cutoff procedure means picking up certain invoices, looking at it whether they have been correctly recorded in the financial statement or not. I would be obtaining external confirmation. Now, when I'm sending the external confirmation, I'd be you should be, as an auditor, I should be sending to top account balances, parties with the long pending dues, because there are chances of having a dispute with those parties, and low value balances. And confirmation should include, now from current year, I would request you to include these 2 points also. Identification of MSME was always there, but please also include to confirm whether there is any dispute with the entity and whether you have filed any legal cases against the entity, which will help us in verifying the disclosure which is given in the financial statement. So control testing is one audit process. Obtaining external confirmation is the another audit process. Similarly, what was discussed in the first session, you also need to give this kind of a disclosure in the financial statement. The management need to give the aging of the trade payable. As an auditor, I would be paying a lot of attention to the long outstanding items which are more than 3 years, because these are the cases which are fraud prone areas, which are having a significant legal disputes, so on and so forth. And I would be also looking at some unusual payments which are made at the year end, or which are reversed in the subsequent period. So basically, I will be looking at checks issued pending clearances. Then I would be also looking at it that this, what do you mean by dispute? What do you mean by dispute? What confirmation I have received, whether those confirmation indicate some dispute with the parties or no. If you look at the disclosure requires you to give some unbilled dues also. How would you present? You will present by a separate column, what Sharika spoke in the first session. Another is that I will be carrying out some analytical procedure, including ratio analysis. I would be carrying analytical procedure, that means comparing the current information with the prior period, comparing entities' financial ratio with the industry average. And as a Schedule 3 requires you to give the disclosure, which is trade payable turnover ratio, which normally indicate credit purchases divided by average trade payable. Now, if you see increasing trade payable turnover ratio, that means there is a faster payout by the company. And if you see decreasing trade payable turnover ratio, that means there is a slower payout by the company. This is one of the important indicator for an auditor to look at it, what is the financial health of the company, that whether they are paying their creditor on time or they're not paying their creditor on time. This is the way our disclosure is reflected in the financial statement. As I said, accrued expenses which are not billed will be coming as a separate line item in the disclosure, because you need to tally the total trade payable amount. Now, based on all these audit procedures, there could be only two things. Here CAM cannot come, here EUM cannot come. What I can report, I can either go and report in my internal financial control over financial reporting para that the controls revolving around booking of the expenses or the purchases are not correct. Second, if the balances are lying since 3 to 4 years like that only, there is no reconciliation prepared, or there is no documents which are made available by the entities for this purpose, I might go and modify the report. Like for example, in the second bullet, if you say modified opinion in absence of detail, the auditor has said what? The auditor said that trade payable need regular monitoring to ensure reduction of liability, which otherwise is increasing on year-on-year basis. No agreement has been provided to him to verify these terms and conditions, and items remaining static when compared to the previous year without any justification, because it gives an indication of a fraud risk over here. So either you can go and report under your IFC reporting, or you can go and modify your audit opinion. These are the two things which you can do, my friend. And looking into all these aspects, my friend, what are the key points which one need to look at it with respect to the trade payable? I need to do IFCFR on accounts payable to ensure the controls are operating effectively. I would obtain independent confirmation. And as I said, my friend, please remember, obtain positive confirmation. I would also verify the compliance of the MSME Act, Companies Act, and other regulatory norms. I would obtain and document the audit evidences. I would report or give a modification in the independent auditor report for any material misstatement. And I would report in IFC for any lapses. So very simple, my friend, for any item of the financial statement, first understand it, audit it, and then report it. If you do these three aspects, an audit includes documentation, because that is the one important area where all of us are little bit lacking in terms of our audit documentation, which need great strengthening, or which needs a lot of information from that, or a lot of improvement from that perspective. So these were the areas which I wanted to cover, and these were some of the important aspects which I thought I should be covering in my presentation. If there are any questions, I am happy to answer them, Anil sir.
Thank you so much, Pankaj ji. Can you hear me?
Yeah, I can hear you.
Thank you so much, Pankaj ji, for enlightening all of us on various audit consideration relating to trade payables and deferred tax. There are 2-3 questions. First one is, kindly explain ECL provision and the risk areas in the deferred tax.
So ECL provision is normally, this is a topic in itself, but I'll try to summarize it. Whenever you need to make a provision, normally under IGAAP, what we do, we say that okay, the debtors are outstanding for more than 180 days, outstanding for 365 days, so on and so forth. So let's make 10%, 20%, 30% provisioning on that part. Now, ECL model is a statistical tool. That means what? Based on the past precedent, I will derive at some, some age matrix, that if the debtors are outstanding from 30 to 60 days, 60 to 90 days, 90 to 180 days, I would be making certain percentage of provision. So that's what the ECL model is. ECL provision is not allowed under the tax laws, because it's normally considered as a provision for bad and doubtful debts, and I would be creating a deferred tax asset on that part.
Yes, sir. So in case of MSME, dues has been paid beyond 45 days. And as per the client, the same has been agreed with the MSME vendors. Hence, the interest need to be provided, whether the same needs to be disclosed in the auditor's report also.
So this is a peculiar situation which I was talking about. Under the MSME Act, you are supposed to pay to the MSME party within 45 days. But what normally the practice is with the parties are that you enter into a separate agreement wherein the payment cycle would be more than 45 days. And if it has been agreed between the parties through a written contract, or it is printed on the invoice that, and the MSME party is confirming that yes, we have agreed to this term that the payment can be made within beyond 45 days, up to 90 days or up to 120 days, depending upon their negotiation. You need not provide any interest, and you need not, I mean, then there is no concept of any disclosure. In absence of this contract, you are required to provide for an MSME interest, whether the party is asking for it or not.
But what is to be affixed on the invoice, sir? As you mentioned, it is to be affixed on the mention in the invoice.
Yes. So in certain cases where there is a typical agreement with the parties, normally MSME entities write in their invoices that please pay within 45 days. In cases where they have a special contract with certain parties, like for example, we have seen in many PSUs, the invoices get delayed beyond more than 45 days. However,
Yes.
they agree with the MSME vendor that we will pay you within 90 days. So in those cases, there is a stamp which is affixed that pay within 90 days, and that clause is not applicable, which is normally printed on those invoices.
Okay. That means stamp should be affixed instead
Yes.
of 45 days. Maybe it is
Yes.
90 days or 60 days.
Yes.
Okay. And if an MSME entity gives a confirmation stating that they waive the interest payable under the MSME Act for delayed payment, can the auditing company not provide the interest?
So this is a typical situation which happens in most of the companies. And if the MSME entities is giving in writing and confirming that we are not entitled or we are not expecting the interest to be received for the entities, number one, these interests should not be provided. And if they are provided, they can be written back also.
And can the interest accrued in the books be written back if not claimed by the MSME entity?
That's what I said. It can be reversed,
Yes.
provided you get a confirmation from the parties.
Okay, sir. One question is relating to the business combination. At the time of the business combination, the new company has virtual certainty of the future profits. In that case, can deferred tax asset as a date of acquisition be recognized through the retained earnings?
So this is the deferred tax asset in case of business combination is separately dealt under Ind AS 12. I'm not very sure what was the question. Now, in case you are having a few, certainty of recovering the deferred tax, I mean, you have a certainty of future taxable profit against which you can recognize, against which you can set off these losses, you would go ahead and recognize the deferred tax asset. Now, deferred tax asset is not recognized through the retained earning. Normally, these are reassessed at each balance sheet date and they are routed through P&L itself.
Oh. Last question, sir. In case of the deferred tax, land is carrying at the amortized value in the books of accounts. Is it required to account deferred tax on difference between amortized cost and the estimated fair value or market value at the financial year end?
So normally these lands which are taken on a lease are normally amortized, because if it is a freehold land, there is no concept of amortization. In case of amortized land where you are charging an amortization to P&L, this will be an item of a temporary difference and will result into what you say a taxable temporary differences, and you need to make a deferred tax adjustment to that effect.
Fine, sir. Thank you so much, Pankaj ji. Your deliberation was also very lucid and in a very explanative manner, and you have justified with your presentation and answered all the related questions. On behalf of Auditing and Assurance Standard Board, I also extend my heartiest thanks towards you for sparing your valuable time.
Thank you so much.
Thank you so much, Pankaj ji. Thank you so much.
Thanks a lot.
Namaste.